Have you ever stopped to think about what money really is? It's more than just paper or numbers in a bank account. It's a promise that the effort you put in today can be stored and used tomorrow. We earn it, save it, and invest it, all based on the shared belief that it will behave predictably. But what happens when that promise breaks? What happens when money stops working the way we expect it to? History is filled with moments when this fundamental trust collapses, and the consequences go far beyond Wall Street. They reshaped entire societies, topple institutions, and redefine power itself. When money starts acting weird, the first casualty is confidence. Think about it. Inflation that skyrockets, interest rates that do nothing to boost the economy, or savings that seem to evaporate overnight. These aren't just numbers on a screen. They undermine our trust in the system. People start to question everything, not just the price of milk, but the very foundation of the economy. This doesn't happen with a sudden bang. It's a quiet, creeping change. We start spending our money faster, we save it in different ways, or we rush to buy things that feel more real, more tangible than a number in an account. One of the first signs that something is wrong is when the old tools stop working. For decades, we've been told that low interest rates encourage people to borrow and invest, sparking economic growth. But what if they don't? What if money is cheap, but nobody is building or hiring? On the flip side, high interest rates are supposed to cool down inflation, but what if prices just keep climbing anyway? When these levers stop controlling the machine, policymakers are left pushing buttons that aren't connected to anything. The economy doesn't just stop. It starts moving in strange, unpredictable ways. This breakdown of expectations often makes inequality much worse. Those who own assets, things like real estate, stocks, or businesses can adapt quickly. They can hedge their bets, change their prices, or move their money to safer places. But for people who earn a wage and save their cash, the story is very different. Their paychecks buy less and less each month. Their savings lose value. Suddenly, time itself feels like an enemy. The longer you hold on to your money, the less it's worth. This creates a silent, constant pressure that changes how we live, how we work, and how we plan for the future. As this uncertainty grows, our idea of what's safe begins to shift. When cash feels risky, people start looking for alternatives. This isn't always a rational, calculated move. It's a psychological one. We see a rush toward things like gold, property, or even foreign currencies. Not because they're perfect, but because they feel less fragile than the money in our pockets. Remember, money only works because we all agree to believe in it. When that belief starts to fade, we look for anything that feels more solid, a way to protect ourselves. Governments get caught in this dilemma too. Public debt, social programs, and national budgets all depend on predictable costs and stable economic conditions. If inflation or interest rates start bouncing around wildly, managing a country's finances becomes a nightmare. Authorities might try to change the rules, move the goalposts, or reframe the narrative. They're not necessarily trying to deceive people. They're trying to restore stability and calm everyone down. At this point, the battle is no longer purely economic. It's psychological. It's a race to restore faith before the fear of collapse actually causes one. The financial markets also transform. Volatility becomes the new normal. The neat patterns and correlations that investors relied on for years suddenly fall apart. Investment strategies that were once surefire winners start to fail spectacularly. Everyone realizes that the old risk models, built on assumptions of a stable world, are now useless. In these moments, the market stops rewarding precise calculations and starts rewarding adaptability. It's no longer about optimizing your returns. It's about survival. But perhaps the most profound change happens in how we view the future. When money works, planning feels natural. We can save for retirement, for our kids' education, for a down payment on a house. But when money becomes unreliable, the future feels like a fog. Planning for next month is hard enough, let alone for the next 20 years. Our decision-making becomes focused on the short term. This shift is subtle, but its effects are massive. It impacts everything from birth rates and innovation to political stability. Money isn't just a tool for buying things. It's a bridge between our present and our future. When that bridge starts to crumble, everything built upon it feels shaky. So, is this all doom and gloom? Not necessarily. History shows us that these periods of monetary breakdown don't last forever, but they always leave scars. New systems are born, new rules are written, and institutions are forced to evolve. Some societies navigate these transitions smoothly, while others fracture under the pressure. The key difference often isn't about how wealthy a nation is, but about how much trust, transparency, and adaptability it has. In the end, when money stops behaving as expected, it's not just a technical glitch in the system. It's a signal, a powerful signal that the world is changing, that the old assumptions no longer hold true. The people who thrive in these moments aren't the ones who panic, they're the ones who observe, who listen, and who understand that when money changes its rules, it's not the end of the game. It's just the beginning of a new one, a new phase that rewards awareness and flexibility over blind certainty. Thanks for watching. If you found this interesting, consider subscribing for more deep dives into how our world really works. See you next time.